It's the Joe Arroyo program on AM 730 and 102.9 FM WTNT. If you have variable income, are self-employed, or a business owner, this is the source for time-tested, tried-and-true financial truths that are proven to work. Now, once again, here's your financial coach, Joe Arroyo.
Welcome back. We have a special guest with us here, in addition to my always special guest, Mr. Matt James. We have Tom Bigoski. Tom Bigoski is the owner of Bigoski Insurance Agency, and you specialize in auto and home, correct? And listen, let me frame this before you open us up, because I definitely want to learn from you some areas that we need to be focusing on. What we do with our insurance is a big deal. I said this before we went into break, and it's important that I emphasize this because I've heard enough horror stories and enough blessings, enough horror stories and enough people saying, thank God I had the right type of coverage when catastrophe struck. And look, you know what? Emergencies, it's about emergencies. Emergencies happen typically unexpectedly. It's not anything any of us want to have happen, but we need to pay attention to it because it has the ability to absolutely decimate our financial life. So, Tom, welcome. Thank you for coming out.
Thank you. So, Monday was April Fool's Day.
Yeah.
And
luckily, I didn't get April Fooled, by the way.
I got April Fooled. You know what I got April Fooled by?
What's that?
Scope mouthwash flavored bacon.
Nice.
I saw this on YouTube. You know the required advertisements you have to watch before seeing a video?
Sure.
And they're talking about this new flavor. I said, oh, my gosh, that's a great idea. So I clicked the website, and I totally forgot it was April 1st. Completely forgot. But it's not
that's
it's not that terrible of an idea.
No,
frankly.
really? Bacon
No,
and
they might have
Scope?
just been testing that idea.
They may
have.
So anyhow, going on, starting with auto. I mean, every one of us drives a car. What do we need to be looking out for?
So when I meet with people and they send me over, my whole career is people sending me their insurance policies, and most people combine their auto and home. So they send me over the auto and home insurance.
Sure.
And one thing most people have in common: nobody likes to pay their insurance. I don't know too many people who once a year love writing out that big
There's
check.
not a ton of fulfillment in the insurance payment.
Right. If your house catches on fire, you're happy that you wrote the check. But no one, I don't even like paying my own insurance. I have my wife do it for me. I can't stand paying it.
Yep.
But most people have absolutely no idea what they're writing the check for.
Right.
And in many cases, if you've got someone in their 30s and 40s, they got their insurance when they were 21 and made very few changes to it over the years. So when I look at people's insurance policy, it's one thing to, a great way to save on insurance is shop around, right?
Sure.
Get some other competitive quotes. But you can really compound your savings by shopping around, getting the best rate, plus doing what I think smart people do with their insurance. So sort of on that theme of April Fools, I want to talk about how do fools insure their cars in their home?
Sure.
And how do smart people insure their cars in their home? So the main thing, if you go on Google and Google smart ways to save on your insurance, you'll get the top 20 results. Every financial genius in the world will have their article about ways to save on insurance.
Sure. Yeah.
And there's one way to save on insurance that every single article will have that we'll talk about in a second. But just real quick, fools, right? Fools don't drive safely. So,
sure, this is a good point.
Insurance companies look at everything. Insurance companies check credit now. Insurance companies, some of them ask if you went to college. They ask what type of occupation. But the most important thing you can do to keep your insurance costs low is don't get tickets.
Okay.
Don't drive like a fool.
Yeah.
And don't try to have a lot of accidents.
Sure.
Try to avoid having accidents. And the other thing that a lot of people don't realize, don't ever let your car insurance lapse.
Ooh.
Having a 30-day plus lapse on your car insurance is worse than almost as bad as having 3 tickets.
Did not know that.
I didn't know that either. I've seen the commercials about this, like, do you have lapse insurance and so on, but I've never understood what the impact was. Why is that? What's the impact?
Well, you have to remember that most insurance companies, they think very skeptical. They're always thinking, if you've had a lapse of a month and all of a sudden you're calling to get insurance, their first reaction, when they're thinking critically, is, well, you haven't had insurance for 2 months, 3 months.
What happened?
Why do you need it now?
Yeah. What'd you do?
You plan on lighting your grill and trying to deep fry a turkey this weekend?
Sure.
You plan on driving fast, going out and having a few drinks this weekend? So letting your insurance lapse is the worst thing you can do to your insurance. It's almost as bad, worse than having an accident.
Wow.
But
And by the way, may I just say I would guess that from an insurance standpoint, they must have noticed a correlation between those who've let their insurance lapse for 30 days and people who had claims. So they must have seen. I mean, this isn't just them being cynical. They're thinking based on what their tables are showing.
And they have to prove right. Because the one thing consumers have to remember is every state has an insurance commissioner. And the insurance commissioner is definitely there just as much on the side of the consumer as they are the insurance guys like me. So in order for insurance companies to have underwriting rules, and they have to, in some ways, justify it. Justify that people that have had a lapse or people that have, had a drunk driving ticket are more of a risk in the future than folks that haven't had them. So, but the one biggest thing, what do fools do and what do smart people do with their insurance? Fools take low liability and low deductibles. Smart people do what our friend Mr. Ramsey says. Sure. Take high liability is the cheapest type of insurance. You can get $2 million of liability insurance for a couple $100s a year. So smart people insure for the catastrophic. They don't insure for if they hit their car into a phone pole and it's $420 to get their car fixed. They insure for high liability, the holy moly type stuff that you've really slammed into someone and their one hand's on the back of their head and the other hand's on the phone to their attorney. That's the stuff that smart people
Something
insure
you
for.
Personally can't insure over, right? And that's the reason behind it. The reason is that you, being financially smart, can set up a small fund, the emergency fund as we recommend it, so that you can insure over your small little accidents and things that are going to happen. You're counting on that happening, but you're insuring it. You're acting as your own insurer, and you're saying, hey, I am living wisely. I am driving as safely as I can. I'm going to be safe around my house. Those little things I can insure on my own, but the catastrophe I can't insure against.
You can't self-insure $2 million, even if you had $20 million cash. It would not make sense to self-insure for $2 million and leave it sitting on the side. There's much smarter ways to earn money that way. But smart people take high liability and they take high deductibles for that exact reason. Now, the key point behind this, the key thing you have to have the $1,000 or the $1,500 emergency fund. All right, car accidents, your shower leaks and water gets all over your house. That's not. For some people, it might be a planned event. But for most people, the safe drivers, the non-foolish folks, they're not planned events. They are emergencies.
Sure.
You hit someone with your car and have to get your car fixed. It's okay to go into the emergency fund to get your car fixed after an accident, not oil changes, right? So oil changes is planned.
Good clarification.
So, I don't want people, because sometimes people are like, well, you're recommending people up their coverages because it's more money for the insurance agent.
Sure.
But I brought a real world example. I just took a customer. I'm going to not mention the name of the customer, but it's your typical mid-30s husband and wife with two regular cars in Virginia. And I kind of ran some numbers here. Full disclosure. I have a mathematics degree from prestigious Millersville University in Lancaster, Pennsylvania.
Very cool. Very good.
So these numbers are very easy. So for listeners, grab a pad and a pen, unless you're driving. In that case, just trust that my math is correct. So I took the Fool, and the Fool has a nice low $25,000 liability limit. And then for their two cars, there's two coverages. There's comprehensive and collision. So comprehensive is windshields and vandalism and hailstorm. And then collision is that you collide with another car. Those two coverages would fix your car. And each of those coverages has a policy deductible. So a Fool does a $50 deductible for comprehensive. So if their windshield breaks, they're only paying $50, and that sounds great. And then collision is $250 deductible. So that Fool would pay, in this example, $1,147 per year. So let's up his liability from $25,000 per person and $50,000 per occurrence to a flat limit of $500,000. That's 20 times as much coverage. Holy
absolutely.
moly, this is going to be big, guys.
So they're protected against the small things. In this foolish policy, you're protected against these little small things that technically you could cover on your own.
Right.
But if you really get into a mess, a couple $100,000 mess, you're not covered.
And the worst part is with those minimum coverages, property damage, which fixes the other guy's car that you hit, $25,000.
Okay.
There's tons of cars worth more than $25,000, particularly Northern Virginia.
Sure, no doubt about it.
So with the $500,000, you get $100,000 to cover that. But that $1,147 only goes up to $1,280.
Wow.
Now, here's the other thing you do. So now we're at $1,280. And this is the point where my customers and my people that call me think I'm just trying to charge them more money. And I say, you have a $1,000 emergency fund, right? It's used for an emergency. So what you do is you take your comprehensive and collision and you make it $1,000 a year. And your rate goes from $1,280 down to $904.
Nice.
$376 a year savings. Now, I have some numbers. Average homeowner, or excuse me, cars. Average two-car family has a claim, a collision or comprehensive claim, once every 8.9 years.
Wow.
So say 9 years.
That means
okay?
I'm due. I haven't had anything for. That means I'm due.
So,
I didn't need to know that.
I'm ahead of schedule.
So take
Okay, good for you. Hey, can you give me a token for
Yeah,
one?
I can give you
Matt's had
tokens.
2.
Yeah.
I'm gonna take one of your tokens. I haven't had any, so we're good.
It's
It's
a
good.
wash.
It's good to go.
So take the $376 a year savings times 9 years, and you get close to $3,000 in savings.
Nice.
And your increased risk is anywhere from $750 for collision or $950. I mean, you can have 3 accidents over those 9 years and still what I call make a profit. It's not, you don't look at it that way,
Right.
but you make a profit. Let's look at home real quick.
But you know what that requires, Tom? That requires a plan. That requires really forward thinking. That requires operating, looking forward, and that requires having your emergency fund, right? Listen, we've got to go to break, but we're going to keep Tom on. Tom will be right back with you. You're listening to the Joe Arroyo Show with my co-host Matt James. You can find us at Joe Arroyo, JoeArroyo.com. We'll be back in 2 minutes.
It's the Joe Arroyo program on AM 730 and 102.9 FM WTNT, getting you from where you are to where you want to be. Once again, here's your financial coach, Joe Arroyo.
All right, welcome back, and we have Mr. Tom Bigoski with us, and Tom is the owner of Bigoski Insurance Agency, specializing in auto and home insurance care, and he's just giving us some education on what we need to be watching out for from an auto perspective, because for a couple extra dollars, what appears to be a couple extra dollars until you talk to someone who's a professional at it, you can make sure that you're actually protected for those things you can't insure for. So, for example, for a couple $100 extra a year in a typical family scenario, you could bump your insurance up and go from a $25,000 to $50,000 total liability coverage, right, all the way up to $500,000, which is really going to be what you need to get if you get into a big fat mess. So this is the kind of insurance buy that's worth the dollars. But then if you follow the financial path as we lay it out for you, if you build up your emergency fund of $1,000 to $1,500 and then your fully funded emergency fund of 3 to 6 months, you can begin to act as your own insurance company to self-insure for those really small items, those things you don't want to and you probably won't call the insurance company for anyways because you don't want them raising your rate. So these are the areas where you can now increase your deductible for those smaller little claims and make sure that you're getting the best bang for the buck on the dollars you're spending for the policy, and the insurance is doing what it's actually supposed to do, which is protect you and your family and protect your finances. Welcome back, Tom.
Thanks. The one thing I want to add, you just actually mentioned this, the thing that's not calculated in this saving, that savings, by the way, before the break, with $376 a year to make those changes, multiplied by 9 years, which is you're going to average one claim every 9 years on your car. It's $3,300 in savings over 9 years. You can have 3 accidents, 3 big accidents over those years, and yes, you're paying $1,000 each time, but the money you save over time makes more sense.
You got a whole nother issue if you've got 3 big accidents and you're the one who's paying for the
because then you turn into a fool.
This is a whole you've got something else going on. This is the point where you should turn the keys in. But go on.
But the uncalculated thing there is having a lower deductible means you're going to make more claims. So you're going to be at the supermarket and you're going to run into a shopping cart and it's going to be $622 to get your car fixed. With a $250 deductible, you're going to claim that. And what could happen to your insurance is what you just said. Your rate goes up.
Sure.
So by going higher, you're also avoiding making claims that, frankly, is what can sometimes give my industry a terrible name, is you put in an $800 claim and your rate goes up. Unfortunately, you put in a claim for $8,000 and surcharges are not tiered. If you have a $100,000 liability claim, it's surcharged the same way a $2,000 claim is. Most companies don't have higher surcharges. So My philosophy is if you're going to have an accident, you better make it a good one.
Yeah, sure.
And so you're avoiding the smaller ones.
Just don't get hurt. Just don't get hurt. Just don't get hurt. But hey, real quick, getting from auto and moving on to the household. For the auto, for the vanishing deductible that you see advertised all over the place, that is simply built into the rate, is it not? Aren't you paying an extra little bit of insurance for this vanishing deductible?
Yeah, vanishing deductible is, in most cases, the companies advertise that it's included. Most of the companies that offer it do have an option without the vanishing deductible option.
Okay.
I mentioned before I'm a math major.
Sure.
I also represent insurance companies that want me to sell all of their stuff.
Sure.
And they're not. Listen, there's a lot of other things that other companies can do to rip you off, but it's like insurance in blackjack. The casinos wouldn't offer it if they weren't making a small cut on it. Paying extra for vanishing deductible, I don't think is a smart move because
for all the reasons we just said.
Right,
well, it doesn't pay off for a long
it doesn't,
time.
And
they know that most likely it's not going to pay off for you.
And even if it doesn't, then you end up making a claim you got taken anyhow. So I mean, there's just
here's what happens: the smart people, the non-fools who drive safe for 15 or 20 years and don't have any accidents. You pay $30 or $40 a year for something that's going to lower your deductible by $100 every year, up to a maximum of $500. So you go 5 years without a claim, you spend $150. But if you have a claim, you pay $500 less. So it sounds like a heck of a deal. The problem is you have to keep paying $30 or $40 a year after that to continue to leave your deductible low. So if you go 10 years without a claim, 20 years without a claim, you've spent $600.
Bottom line on the auto is what?
Just insure for the stuff that you could not take care of on your own.
And when you start getting into the high liabilities, even if you have the money in the bank, the insurance for it, dollar for dollar, is pretty darn cheap.
Right. Insure for the catastrophic stuff.
Insure for the catastrophic and make sure you're covering. So moving on from auto, what are we looking at for our house? I mean, this is a big deal. And I'll tell you something, Tom. We deal a lot with housing here. Matt's the team leader, which is basically the he runs the Keller Williams office in Chantilly, which is one of the top 100 brokerages in the country. And we do a lot of mortgage volume. And one of the things we see all the time on insurance policies is insurance goes up and up and up and up year over year. So sometimes, for example, when someone comes back to refinance a house, you will look at it and say, gee, your insurance policy is X a month, and then they shop it around and they're saving 40% off of where they were at. And they're like, how did this happen? What happened? What happened there? How do you go from being one of the best price policies because you shopped it around, you got a good price, you bought your house, and the next thing you know, you turn around, you didn't mess with it, it's in your escrow, so it's being automatically paid in your mortgage payment. You look back 5, 6, 7 years down the road, and you've been wasting, $600 a year. How's that happen?
Well, there's a lot of reasons. In some cases, you may have bought home insurance years and years ago before insurance companies looked at credit, and you got an average rate. You got to look at it. 20 years ago, insurance companies had 2 or 3 rates for home insurance.
Sure.
They had a frame construction house, a masonry construction house. They had maybe a rate if you've had claims, and maybe a rate if you haven't had claims. Mm-hmm. Yeah, nowadays it's basically just there's no way for me to figure a rate in my head anymore. We enter this stuff in the computer, and it's credit. Some of these insurance companies have gotten real slick, and they look at neighborhoods now. They look at response times from the local fire departments. So now's definitely a good time to be shopping around for home insurance.
Okay.
Probably even more so. Car insurance is pretty easy to predict.
Yeah.
Home insurance is not easy to predict, and it's only going to get higher.
Now I know in the mortgage world, for example, mortgage broker is a dirty word. You don't use it. This is not something you want to go to or use. But insurance, I found the exact opposite to be true. We found insurance providers who are brokers, who are not tied to one provider, typically are providing much better rates, much better coverage, and much better service because they're able to really accurately, like you were saying, I mean, at the end of the day, you want to sell some insurance. You have to sell some insurance, but this gives you an opportunity to have multiple products to select from that people have to offer. So from a broker, which you are a broker, correct?
Yeah.
Why is it, and maybe I just named the reasons, but if there's others, why is it that an insurance broker is the guy to go to maybe instead of I'm just going to have a knee-jerk call to USAA or Navy, any of the other major nationwide insurance providers?
Yeah. I don't want to rip on captive agents because you just named a couple. You named USAA, you named State Farm. I don't work with them. I
No,
work
I'm not
for-
asking you to
yeah.
indict their company. I'm talking
Right.
strictly from a financial standpoint. Why is it that you're typically able to give a better quote? And
Well,
better...
I'll explain it this way. I'm an ELP for Ramsey. That he requires that we be independent agents.
Okay.
Independent agent, insurance broker, it's the same thing.
Yep.
We call ourselves independent agents. Makes us sound more
Yep.
important. But independent agents, because he requires that because we are able to shop multiple companies.
Right.
And at the same time, it's important to know, I have several companies, but there's 3 or 4 solid companies I work with that I know their underwriting.
Sure.
I know their claim reputation. I know their underwriters and their claim adjusters personally to call with questions. So if I had 20 or 30 companies, I might not be doing a service to my customers
Right.
because I don't.
Right.
It's impossible to know every single
You'd
company.
be a maximizer, not a satisfizer, and that's a
Right.
whole other
Yep.
topic.
Yep.
Right. You want me to get into the savings part for home real quick?
Well, yeah, definitely. We have got a couple minutes. I'd like to make sure we got a couple key points, walk-away points with the housing.
Just the same point about low liability, low deductible.
Mm-hmm.
High liability, high deductible makes just as much sense for home. So I ran a low 100,000 liability home policy with a $250 deductible, and it's $810 a year.
Okay.
To raise your liability to $500K, $810 goes to $827. Ridiculously low.
Wow.
Not a big difference. Now let's make that deductible go from $250 to $1,000. So $750 more if you have a claim. $718 a year, $109 a year savings. You fill in the blank. I bet you get this wrong. Average homeowner has a claim once every blank years.
4 years.
Well, I'm going to guess like 14 years.
12.
16 and a half.
Wow.
But everybody.
Did I get a prize? That was close.
That was very good.
Wow.
Everybody guesses
Very good.
low on that. Average
Yeah.
homeowner has a claim, and there's people that have 2 and 3 at a
Sure.
time. But for everyone that has 2 and 3, there's 20 people who tell me, I've had home insurance for 40
Yeah.
years. I've
Yeah.
never had a claim. So if you look at it, over 16 and a half years, that person saves $1,800.
Okay, hey, I've got a real quick question for you. That's a bit of advice. Can you sum that advice up real quick?
High
What you just
liability,
gave? Yeah.
high liability, high deductible.
High liability, high deductible. That goes for your housing as well. On the insurance policy, when you can opt for replacement cost versus what the insured amount is, as the mortgage is reducing because you're paying off the mortgage, is replacement cost, is that a good buy? Is that a good buy to get full replacement cost on your house?
If you want to have your
catastrophe?
house rebuilt, absolutely.
Okay.
And there's actually even one that goes a little better than
Uh-huh.
that. There's what they recommend as an ELP that is a guaranteed replacement, meaning
Okay.
insurance company charges you a rate that's appropriate from what they think the replacement is.
Uh-huh.
But if your house burns down, if your dwelling coverage says 400, they'll pay. Even if it's more, they'll pay 500 if it costs that.
Beautiful.
Very few companies have guaranteed anymore, but there's some left that do.
Very nice. One quick story. You may not remember this house. It was over on 38th Street, and it was one of the first rental properties we bought. Probably one of the worst rental properties we bought. This thing turned out it was one of the worst places you could own. Okay, I get a call one night in the middle of the night. A freak storm had come through without rain. Literally, a bolt of lightning struck the house, only this house, and it burnt it down to the ground. Because we had the right type of insurance on it for replacement costs, not only could we rebuild it and replace it, but we got an additional 30 grand from the house, and it was one of the best things that ever happened. A freak
And it's how we met Ami Warfield. Ami Warfield built the house.
A freak bolt of lightning comes out of the sky. I was like, Jesus, this is, and I don't really believe it was Jesus, don't get me wrong, but he still got the thanks. So anyways, you're listening to the Joe Arroyo Show with my co-host Matt James. Tom Bigoski, thank you very much for joining us. Tom with Bigoski Insurance Agency, educating us on auto and home. You can find more of us at Joe Arroyo, JoeArroyo.com for our podcast, our blog, our local workshop schedule where we teach you the time-tested, tried and true financial principles that are proven to work. We will see you next time.